So here we are again. We are at lecture number 5. Did y'all do your homework? Okay, let's go over that homework. But the first thing I want to do before I forget is I believe we talked about doing exercise 1.9 today, right? Because I didn't get to it last time. Is that correct? So let's go over exercise 1.9. And I think I gave you a little bit of a hint on maybe how to think through that, because sometimes that can be a little bit tricky, okay? So let me go ahead and put up the question. The question is down here. I'll zoom in on it, okay? I won't leave it there long, but sometimes the people at home in the online class need to see that, okay? All right. Now, the way that I solve this is I recognize that assets equals liabilities plus owner's equity, right? This has to be true at the beginning of the year, or the beginning of the period, I should say, at the end of the period, and the net change for that period even, okay? Let me show you what I'm talking about. Okay, exercise 1.9a. I'm just going to fill in this information as we know it, okay? At the beginning of the year, Addison's company's assets are $300,000. Okay, and its equity is $100,000. Okay, well, let's stop for a second. Do we know what liabilities were? $200,000. Let's just go ahead and put that there. During the year, assets increased by $80,000. So these went up by $80,000. So at the end of the period, they were $380,000, correct? And liabilities increased $50,000. So these went up by $50,000, correct? So 200 plus 50 is 250. You with me? Then what does it ask for? What's the equity at year end? Well, what is equity? 130. These two equal that. These two equal that. How much did owner's equity go up by? These two equal that. So it works out every way, doesn't it? Kind of like a puzzle, isn't it? Kind of fun, isn't it? Okay. Does that make sense? Okay, good. Questions on that? That's A. Let's do the rest of the problem. B is pretty easy. Office store had assets equal to 123 and liabilities equal to 47 at year end. What is the equity? What is the equity? You tell me.
6.
Is it 70 what?
76,000.
76? Okay, 76,000. Does that sound right? Yeah, 76,000. That was pretty easy, wasn't it? Let's do C, and let's use this same format, okay? And again, I'll just put things in as we know them. So this is C. At the beginning of the year, Quaker Company's liabilities equal 70,000. During the year, assets increased by 60,000. Okay? And at year end, assets equal 190. Okay, let's just stop for a second. Do we know what assets were at the beginning of the period? What were they, 130?
130.
130 plus 60 equals 90. Do we know owner's equity at the beginning of the period now? Yes.
Yes, 60.
It had to be 60, didn't it? Okay, let's keep reading. Liabilities decreased 5,000 during the year. I'll use parentheses to denote subtraction. 70 minus 5 is what? 65,000. They want to know what the beginning and ending amounts of equity are. Well, if we know that, we can figure out what owner's equity was at the end of the period, right? What was it?
125,000.
How much?
125,000.
125. So how much did owner's equity increase by?
65.
Right? They went up by 65,000. So that plus that equals that. That minus that equals that. That plus that equals that. These two equal that. These two equal that. these two equal that. Is that correct? Okay. Does that kind of help you? Okay. I'm the kind of I have to write everything down. Is anybody like that? Kind of a visual learner? I have to write things down. So my wife and I was talking to her on the way home last night about our month coming up, and I was like, I have to have a calendar in front of me before we have this discussion. So let me wait till I get home. I have to see the calendar. So write things down when you can, and it'll always help. All right, let's go through the rest of the homework, okay? Let's go through the rest of the homework. The next one I assigned was Quick Study 112. Is that correct? Now, I always have a test question like this, okay? I have a test question like this. And this is the sort of question you should be able to answer, okay? It's up there at the top. When students are struggling in this class and they come into my office for help, one of the first things I ask them is I'll list off some accounts. And I'll say, do you know what financial statements these accounts go on? You tell me. And if they get them all wrong, I know what the problem is. Because another layer of that foundation in there is, do you know what financial statements the accounts go on? Are you with me? Now, a few of these were the statement of cash flows, which you're not responsible for doing. I'll just tell you those, okay? All right, assets goes on what? Balance sheet, okay? Cash from operating activities. That goes on the statement of cash flows. Now, cash goes on the balance sheet, but this cash from operating activities, that's a specific subtotal in the statement of cash flows. I would not expect you to know that. But of course, cash goes on the balance sheet, right? Maria?
Is that like, you know, when you get your bank statement, like where it says like the specific one where it says, well, you wasted $30 at Walmart, certain Walmart?
It's kind of like that. It's involved in that, but it's not exactly the same thing. Okay, good question though. Withdrawals. Where do withdrawals go? Sometimes withdrawals is a tricky one. Statement of equity, or sometimes we call it the statement of owner's equity. Withdrawals goes on the statement of equity, okay? Equipment goes on the balance sheet. Expenses go on the
I said
Income statement.
income statement. Income statement is revenues minus your expenses, hopefully equals a net income. Expenses on the income statement. Liabilities go on the balance sheet. Net decrease or increase in cash, that's a statement of cash flows. Okay. What about revenues?
Income statement.
Income statement. Total liabilities and equity.
Balance.
Use your words. Balance sheet, right? I want this to be easy. Okay, I want this to be easy. Okay. Any questions on that? What if I would have had one that said ending balance of capital? Ending balance of capital. What's the answer?
Equity. That'd be balance.
A trick question. Ending balance of capital is actually on the statement of equity. So it would be statement of equity, but then it flows over to the balance sheet. So it's also balance sheet. So it'd be statement of equity and balance sheet. Make sense? You with me? Okay, questions on that? All right. The other one that I had for you to do was exercise 115. Is that correct? Okay. Now, take a look at that. Exercise 115. On October 1, Ebony Ernst organized Ernst Consulting. It's hard to say. On October 3rd, the owner contributed $84,000 in assets to launch the business. Okay, and you can see that down there. That occurred on October 3rd. On October 31st, the company records show the following items and amounts. Use this information to prepare an October income statement for the business. Now, she started the company on October 1st, right? So the first thing that I do is this, I go through these and I say, okay, what financial statement do these items go on? So this is kind of like we're doing Quick Study 112 again. Cash goes on the what? Use your words. We know where cash goes, right? What financial statement does cash go on? Balance sheet. Okay. What about accounts receivable? Accounts receivable is an asset. It goes on the what? Balance sheet. As a matter of fact, all these go on the balance sheet. Okay. Asset, 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 liability, or no, asset, 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 liability. Assets and liabilities go on the balance sheet, right? Okay. They've made this easy for you. They've grouped them together. Statement of equity. This owner's investment of $84,000 that occurred right here, that goes on the statement of equity, correct? What about withdrawals? Where does that go? Statement of equity, thank you. What about consulting revenue? Income statement. What about all these expenses? Where do they go?
Income statement.
Income statement. Now, they made this easy. They grouped them all together. So you might think, well, this is not really a necessary step, Dave. Well, we're going to do one here in class today. We're going to work on one in class where I've made it a little bit more challenging. And you'll see why it is very helpful to do this before. Okay? Now, what is the first financial statement that we prepare?
Income statement.
The income statement. So what I would also recommend that you do is, as you prepare these statements, as you're doing these statements, make sure that you indicate in some way that you've put it on a statement. Okay? Let me show you what I mean. Let me get the answer out here. Okay. We're going to do the income statement first, right? So, as you put the revenue on there, I would circle that. As you put rent expense and salaries expense, telephone expense, miscellaneous expense, circle those, okay? Let's say that we just prepared our income statement. I'll put it right there. See if I can get both these on the screen. I need to zoom out. Okay, there is the income statement. So go ahead and take a look at that for just a few seconds to check your work, and then I'll talk about it. Maria.
When preparing the sheet, do you want us to on there how the 14's on the right and then the other numbers are on the left to show?
We'll talk about that.
Okay.
Let's talk about that. Okay, let's talk about this a little bit. First of all, envision yourself as you're preparing this to circle these. Why am I saying to circle these? Because what happens if you don't do that is you'll forget to put an account on a financial statement. Or you'll put the same account twice. Are you with me? So this ensures that you put these items on a financial statement, but only one financial statement. Are you with me? Okay. So as you prepare these, circle those. We'll keep doing that as we prepare the other statements. Okay, we have revenues of $14,000. We have expenses, and you need to list them all out. Sometimes students will just say total expenses, $11,890. Well, that doesn't give the reader as much information as if you list these, right? So list these out, these expenses, then total them up. Revenues less expense equals net income. Okay? Now, let me address some of the questions that students often have. What if I listed my expenses in different order? That's fine. Okay? A lot of times they'll list them from largest to smallest. Okay? But I wouldn't take off. Okay? Make sure, see that 2110? You might put a double underline there. Okay? Make sure it's not without a label. I don't like items without labels. What is that 2110? That's the net income. Are you with me? Okay. Let me talk about dollar signs real quick. And students will say, Dave, do I need to put a dollar sign on everything? Here's what I usually do, and I would encourage you to do this. I always put a dollar sign on the top number and the bottom number. But you don't need to go nuts with dollar signs. Okay? Some students put them on every number, and it just looks it's a little much overboard, okay? So I usually put a dollar sign on the top, dollar sign on the bottom. Now, is this prepared in proper form or good form? Yes. What do I mean by that? It's the name of the company, it's the name of the statement, and it says for the month ended October 31st. I would have lovingly taken off a point on your test if you would have just said October 31st. We talked about that, right? So make sure it says for the month ended. Maria asked a good question. She said, well, do you want that in that column and these? Yours might look a little different, okay? Yours might look a little different. It's just like, remember the free throw report that I prepared for my coach? Some other statistician at a different school, theirs might look a little different, but it conveys the same information. I'm going to guess yours conveys the same information. It's just maybe you didn't put these in its own separate column. Is that what I'm hearing?
I changed them because at first I was going to do it like that, but then I did it all straight down, but that way it's more organized. So I took an accounting class at the high school, and the teacher always wanted us to do it like that because then you could see the amount, like the total amount, and not get confused with if you've done already the total amount. If not,
Yeah. Sometimes that's helpful. Where'd you go to school?
Gardner Edgerton High School.
Okay, good. All right. Any questions on the income statement? Okay, what's the next statement we prepare after the income statement?
Equity.
The statement of equity. Now, this is a brand new company, so what is the beginning balance of capital going to be? Zero. It's not always going to be zero, right? We're going to add the investments that the owner made during the month, right? We're going to also add net income. We're going to subtract withdrawals, right? So from this list here, going to the document camera, we're going to use this guy right here. We're going to use this guy right here. Let's see if I can move this. That net income flows down to here. And I circled the items that we used on this statement of equity, correct? Now, let's take a look at it. Is it prepared in good form? Yes. Name of the company, the name of the financial statement, and it's dated properly. The dating will always look the same as the income statement. For the month ended. I'd lovingly take off a point if you just said October 31st. Make sure, even though it's zero, some students won't put this line. No, don't. Even though it would work out mathematically, you want to say the beginning balance of capital at the beginning of the period is that. Make sure you label that bottom line. A lot of times students won't label that one. Ending balance of capital, or capital at October 31st. You add the investments that the owner made. Sometimes they don't make any investments during the month or the period. You put the net income in there that flows down from the income statement. See this little subtotal there? I usually don't do that subtotal personally. You can do it if you want. Notice it's not labeled. That's because it's kind of a meaningless number. Okay? Withdrawals are subtracted, and that gives you the ending balance of capital. They put a dollar sign up here, they put a dollar sign up down there. Are you with me? Any questions on the statement of equity? Okay. What's the next financial statement we prepare? And we're going to take this capital balance of 84,110 over to the balance sheet, right? So we're going to put these assets, the liability over there, right? So now I will have used everything and only used it once, correct? Okay, so let's take a look at the balance sheet. All right, that ending balance of capital is going to flow over to it. There it is right there, correct? 84,110. So take a second to look at this balance sheet. Okay, let's take a look at this. You have your assets. What if I listed them in a different order? That's okay. What if I put instead of left and right, I went up and down? That's okay. You list out your assets. Label each one. Now, that's not a balance sheet, right? If you just put numbers. You got to put labels. This is not a balance sheet with just numbers and no title or heading. It needs to be prepared in proper form. So you have your assets, your ending balance. Total them up. Don't just leave that hanging. I take a point off on the test if you just say 92,610. No, that's total assets. That is total liabilities plus equity. You with me? They did the dollar sign on top, the dollar sign on the bottom, they double underlined. Is this prepared in good form or proper form? Yes. The name of the company, the name of the statement, and they dated it properly. I would lovingly take off a point if you would have accidentally said for the month ended, because they did not have $11,360 of cash every day of October, did they? This is point in time. So either say October 31st or as of October 31st. Of course, if they had the year, you'd put that there too, right? There's capital. If there would have been a number of liabilities, I would have had a subtotal for total liabilities, but there's only one. Tell me the questions you have on these. Any questions? Any questions, guys? Did you get that? Preparing financial statements. I guarantee on your first test, which will be after lecture 10, your first test, you will have to prepare all 3 financial statements, okay? We're going to practice this in class. Let me talk about a couple of things real quick, though, that sometimes I see students struggle with, okay? Okay, sometimes they will see an account called, consulting fees earned, or interest earned. And they're like, what does that mean? What is that earned thing? Well, consulting fees earned is the same thing. It's just a different way of saying consulting fees revenue. Interest earned is the same thing as interest revenue, okay? Personally, I don't use the earned. I always title all of my revenue accounts revenue and all my expense accounts expense, okay? But sometimes you'll see this terminology here. Just know that it's the same thing as this. And of course, these all go on the income statement, correct? You with me? Another thing you'll see sometimes is this. A/R. A/R stands for accounts receivable. A/P stands for accounts payable. N/R stands for notes receivable. N/P stands for notes payable. Accounts receivable, accounts payable, notes receivable, notes payable. You'll see these abbreviations a lot, and I'll use them. I want to be thinking about it. Okay, I want to make sure you know that. All right? Questions? Okay. Let me go to something that's very important, and that is there are certain principles and assumptions of accounting, right? And we talked about the revenue recognition principle, didn't we? You hear me say this a lot. We're going to talk about these others, but let's remind ourselves what the revenue recognition principle is. The revenue recognition principle states that we recognize revenue when it is earned. That's not necessarily the same time we receive cash. When is it earned? When can we recognize revenue? When the product or service has been provided to the customer. Okay? This is important. So important, I want to go over this. Let's say that the new iPhone was coming out, okay? Everybody gets so excited when the new iPhone comes out, right? So let's say that the Apple Store makes this announcement that says, hey, the new iPhone is coming out, okay? And if you want to get yours early, if you come in and prepay for your iPhone, we'll notify you as soon as we get them, You can come in the store, pick it up, and you'll be so much happier because you'll have the new iPhone. All the problems in your life will be solved, okay? So you decide to do this, okay? So you go in, the new iPhones, let's say they're $500, okay? You give $500 cash to the Apple Store. Are you with me? Now let's look from the perspective of the Apple Store. They just received your cash of $500, okay? Well, if we're doing transactional analysis, cash went up by 500. And what else went up by 500? This account called unearned revenue. Unearned revenue. Now, I want to talk about this account. Unearned revenue is not a revenue account. It's not. But it says revenue. No, it's not a revenue account. It is a liability. Because think of that point from the Apple Store perspective. They owe you either the new iPhone or your $500 back, right? So unearned revenue. Now, I just told you that I call my revenues by revenue. That doesn't mean, though, that unearned revenue is a revenue. Unearned revenue is a liability. So what financial statement do liabilities go on? The balance sheet, correct? So where do you think unearned revenue goes? The balance sheet, okay? How does the Apple Store earn that revenue? Let's say the new iPhones come in and you come and pick it up. You grab it from them and you go home and you're so much happier now. Well, at that point, if you're the Apple Store, your liability decreases by 500, your revenue goes up by 500. That's how we handle that. You with me? Okay? Questions on that? Let's talk about these other principles. The cost principle. This says that accounting information is based on actual cost because that's considered objective. So, Tanner, let's say you go buy for your company a used truck, and let's say you pay $12,000 and you write a check for it, okay? Well, you feel like you got a good deal. You go over to your mechanic says, Tanner, you got a fantastic deal. You paid $12,000 for this? This truck is at least worth $15,000. And you look it up in the Kelley Blue Book, and sure enough, it says it's worth like $16,000. Well, what do you list that truck on as an asset in your records? $12,000. Because that is considered objective. You can show somebody the check and say, see the $12,000? That's how much I paid for it. You could distort things quite easily if you just, well, I'm going to list my assets at what I think they're worth. You see what I'm saying? That's too subjective. We list things at their cost because that is objective. Make sense? Mm-hmm. Matching principle. That's a chapter 3 concept. We'll come back to that. Full disclosure principle. A company is required to report the details behind financial statements that would impact users' decisions. Okay, let me show you something here. You don't have to dig through your book. In the back of your book, at the very end, after even chapter 24, which is more of a, which is you'll do in accounting too, they have this appendix A, and this has actual financial statements. These are not made up. These are real financial statements. And one of the companies they list is Apple. And you can see Apple's balance sheet, and you can see their total assets. You can see their total liabilities and stockholder equity. Okay? You can see their income statement. They use the term statement of operations. That's another term for the income statement. You can see their net income. You can see the statement of equity. You can see the statement of cash flows. These are real life things. These are not made up numbers for Apple. Okay? You might want to take a look at these. Well, after that, they have what's called the notes to the consolidated financial statements. And they have all this verbiage. okay, over the next few pages. And these are very, very, then they skipped to Google, okay, but these are selected notes for Apple. This is very important information. This is where they tell you things like what the company does, where they have operations, what sort of products do they sell, all those sorts of things, okay? They put that information there to satisfy the full disclosure principle because they give all the details behind the financial statements. That certainly would impact decisions. They talk about all sorts of stuff in there. As a matter of fact, a common problem that you'll have maybe in business school is they'll want you to analyze the annual report, the real life financial statements and notes for a company. I always say read the notes first and then read the financial statements, okay? All right, let's go on to the next slide. The going concern assumption. What does that mean? That means unless stated otherwise, you can assume that the preparers of the financial statement feel that the company will continue going on in the future. It's not going to go bankrupt or be dissolved or something, okay? Now, if they did think it was going to go bankrupt or be dissolved or something, go out of business, they would need to tell you, because certainly that affects everything, right? Your receivables, your payables, everything. But if you don't read that, you can assume the business will continue operating. That's the going concern assumption. What's the monetary unit assumption? That simply states that we put our financial statements in monetary unit form. When we did the financial statements a second ago, they were in dollars, right? Okay. If you're in Japan, they'd be in the yen. Okay. If you're in Europe, they'd be the euro. But we can put things in monetary units. The business entity assumption. Is somebody's phone going off? Oh, if your phone goes off, oh, that's big trouble, Tony. Big trouble. Just kidding you. Not really, though. Okay, business entity assumption. This means that you keep track of your business totally separate from other businesses, okay? Or separate from your personal life. You don't want to be writing checks for your business in the same checkbook as your personal life, your groceries, or you don't want to commingle things. We talked about this earlier in the semester, didn't we? Just like you keep a separate notebook for each class that you're taking, it'd be a mess if they were all in the same notebook, or they won't divide it out somehow. Okay, that's the business entity assumption. The time period assumption simply means that we can break out a company into periods of time. That's why our income statement said for the month ended, or it might say for the year ended. We can segregate that activity. Are you with me? Okay, questions? Okay, what we're going to do now, we're going to spend some time doing this. And I want you in class to do this, and I want you folks at home to do this as well. They're going to play some really nice music that you'll enjoy for folks at home, okay? But if you look in your handouts, you're going to see, lecture 5, the Valentine tree trimming handout. They want you to prepare the financial statements. Now, I have listed the accounts not by financial statement, but in alphabetical order. So the first thing that you should do, folks, is go through these. What financial statement does accounts payable go on?
Liabilities.
Yeah, so it goes on the balance sheet. What about accounts receivable? Balance sheet. Do that for all of these because they're all mixed up. And then as you put them on a financial statement, circle them or put a check mark by them. Now, you'll notice I'm having you do August 18, the month that did August of 2018. This is not a brand new company, so there is a beginning capital balance. Are you with me? It won't be zero. We have unearned revenue there. Now, I'm going to get you started here in about 15 seconds. Here are some check figures. Okay, I'm going to leave these on here. For you folks at home and for you folks here in the classroom, I'm going to let the music play for a while, but you're going to see that after a while I'm going to put up the income statement. And then a little later I'll put up the statement equity. So you folks at home, be watching that on the screen so that you can start to check them as you're doing these. We prepare them income statement, statement of equity, balance sheet. This is a past test question. I guarantee you will have a test question like this, okay? So let's play that music. There's the check figures. You guys can work together, check answers. Please, folks at home, don't just fast forward. Listen to the music or pause this. Work on these at home, okay? Because this is a very important skill. So let's play that music. Let's work on these. Oh, one more thing. Don't just try to scrunch them all up. You know, all 3 financial statements right here. Get another piece of paper or use the other sheet. These need to be legible. Or if people can't read them and they're so small and messy, then they're not of much help. So you have paper, use it, and let's work on Valentine tree trimming. Okay, I know I rushed you folks a little bit with this. If you folks at home, of course, you have the luxury of pausing if you're not done. But I want to make sure you guys know how to do that. Doing a complete set of financial statements like that, of that size, probably should take 10, 11 minutes. If it's taking you 20 minutes, it's too long. If you guys were really struggling with this, you didn't even know where to start, you were just spinning your wheels, know this, that should be a little cause for concern, okay? I want you to be able to do this, okay? And I have another set of financial statements for you to do for your homework, okay? But like I said, this is a past test question. Are there any quick questions about Valentine? You can see unearned revenues there. That plus that equals that. Okay, this is a top to bottom. That's fine as opposed to left, right. Okay, let me give you one last announcement. Of course, do the homework that is on your homework sheet, okay? Now, we have a very key lecture. Lecture number 6 is a very, very key lecture, okay? I say that because of this. I really encourage you at this point, folks here, folks at home, you need to make sure you're not behind in any way before you come to lecture 6. You need to make sure, do you understand the accounting equation? How equity changes? Do you know how to do transaction analysis? Do you know what accounts, what financial statements that different accounts go on? Are you getting to the point where you can prepare those financial statements? You need to have those layers of your house solid. So if you're behind, remember the bus analogy? I am definitely saying last call to get on the bus. And lecture 6, after lecture 6, I'm going to slowly start driving away, and I want you all to be there with me, okay? But know this, know those layers of your house, those foundational accounting concepts before you do and come to lecture 6. Make sure you're doing your homework. Make sure you do this homework, folks, okay? That's on your gold sheet. We'll go over that the next time, and we'll talk about some very important things. Have a good day.